GCR signed a marketing deal with Metropol in 2006, and 3 years ago the negotiation to have the majority acquisition started. Why has it taken this long?
The main driver for this deal was the number of companies that are coming up for rating, because GCR was looking at what would justify them to set up a rating office now here in Kenya. So we had agreed that if our marketing effort could be able to generate sufficient numbers that could attract or could sustain an office here, then that would then happen. Having hit the 80 ratings mark now for the region, I think that we are moving very quickly to getting the critical mass that would facilitate the setting up of that particular office.
With the entry of GCR, how is this going to change the credit rating space in Kenya?
The capital market in Kenya is very well developed, but what we see is that the equity market is more vibrant than the bond market. Now, fund managers and pension funds can only invest in either a rated company or a listed company. And therefore, if we get more companies rated, it means it creates an opportunity for the fund managers to invest in these entities. And that has been the drive that we've been putting forward, that investment companies or companies seeking to raise funds need to get a rating if they are not listed, to allow the fund managers to invest in the instruments that they are putting into the market.
The deal between GCR and Metropol is coming 5 months after we saw another Nigerian company, Augusto, coming into the Kenyan market. What does this signal for you? Why are we seeing this interest in Kenya?
If you look deeply into what has been happening, there are a few ratings that have been done by Moody's and Fitch. I know of a few banks that have gotten a Fitch rating. And therefore, you'd find that a bank has a Fitch rating and they also have a GCR rating. Both of them try to ensure that the benchmarking that is being provided is both of an international nature, and at least an investor can see that two opinions given by well-established rating companies give a fair assessment of the institution. So you'll find that when you have one or two rating companies in the market, most of the entities will actually have two ratings, which provide a comparison of the risk of investing in that particular entity. So it's a plus actually for the investing community.
At this point, I'd actually now want to ask about the companies that you project to have rated. You've mentioned that you have 80. At the end of the year, what is your projection?
I think this year we think we could hit about 90 companies because an interesting thing did happen after this election, that we saw an increased demand for ratings from quite a number of companies, including insurance firms, as opposed to the previous time after the 2007 elections, where we really saw a slump in the demand for ratings. Given this positive outlook on the Kenyan economy, the regional economy, I think that we will have more companies seeking for ratings, and in view of the fact that they have to expand and they need funds to manage those expansion. And part of the money is actually going to come from the debt market. And in the debt market, that's where ratings become critical.
In line of what you've just mentioned, we have the county governments now coming up and saying that they'd like to raise some capital to plug the budget deficits that we're seeing them having. We have seen some counties such as the Bomet County, we've seen Bungoma and Meru saying that they'd like to raise some capital. Have you seen this interest? Have you seen them coming for ratings?
I think what the counties have been doing is to explore the other opportunities available for them to raise investment capital, because they are looking at the national government will provide most of the funds required for recurrent expenditure. But if a county is serious about investing in infrastructure, water projects, health institutions, they will have to look for funding elsewhere. And some of them are trying to find out that what are our chances of raising money from the debt market. Now, in the South African market, for example, where you have municipal councils with a GCR rating have issued what you call munis bonds. And through these munis bonds, they've been able to raise a lot of capital, which invested in infrastructure projects. It's along the same lines that we're saying that counties can also get ratings, because counties swallowed the former municipal councils. If counties get ratings, then they can be able to issue bonds in their own names.
And finally, what is your outlook in terms of expansion and even introduction of other products within the region?
We're looking at exploring new avenues, like going into asset-backed securities. Asset-backed securities provide a much more expanded area of funding, where loans are securitized and taken to the market, mortgages are securitized and taken to the market. This provides a humble opportunity for more investment funds to flow in. The law that will allow asset-backed securities to take place has just been passed by the Capital Markets Authority. So it's an area that we expect to see a lot of growth. We also would like to expand the area of coverage. Our current agreement with GCR has been covering about 5 countries for the East African region, but we now want to expand that to the COMESA to cover more countries where we are seeing a continental flow of investments and trade.